All right, so let's talk about this factoring entry. It's the new one. We're financing with our receivables. Remember, the idea here is I'm wanting to sell my receivables because I need the cash now. I can't wait for my customer payment. The way that I think it helps to lay it out for me, and it helps visually break down what's going on, is we start with the $300,000 of accounts receivable that have been factored. And it's the factoring transaction, almost or really any journal entry is sort of okay. The credit is broken into multiple debits, explaining different pieces of it, or the debits broken into multiple credits. So we're going to break this out. We receive 95%. Okay, real quick side note. All of these percents are going to be taken from this amount here. So don't apply percents really to any of the other sub calculations, um, just to this. So 95% of the cash is being advanced. And that is 95% of 300,000 is 285. And the factor is withholding 5% of the cash for its own assurances, right? It's buying receivables. Receivables aren't always at their dollar value that they're listed at on the seller's books because we have discounts going on, we've got returns going on, we got some bad debt going in there. And the bank knows that. They want to hold some back to safeguard. Well, the bank, because it's assuming risk, right? It might be that none of these accounts are bad, but there's still risk that they could be some in there that are bad. They'll always take a factor fee. And that factor fee is 2%. Again, we apply it to the accounts receivable factored, and that is a $6,000 factor fee. So after the bank takes that fee, after that's removed, only $9,000 of the withheld receivable value is left. Well, the company makes the seller makes its own assessment of what they just sold, right? We, the seller, in this case, Dobby, we know that these receivables won't be collected on a dollar for dollar basis because of all the things I mentioned. But in this case, it's pretty savage. They think that the true fair value is 4,500. Fair value just means what we're really going to get from this. It's kind of like net realizable value. Well, we have to make an adjustment to make the receivables that amount of money. And so that adjustment is part of the loss that we're going to recognize here in our journal entry. So I make that adjustment to fair value. What's remaining then is a $4,500 balance. This is my receivable from factor. Right? And of course, the 285 up here was my cash. So I'm going to start laying out the journal entry for it with this sort of breakdown of the information over on the margin. Um, I sold receivables. That means we're going to credit those because we no longer retain ownership to them. We should remove them as assets on our balance sheet. And I received cash, 285,000. The receivable from factor gets recorded here. And the only pieces that are missing right now are the 6,000 and the 4,500. These will be two components of the loss on sale that I'm going to record here. But there's a third component that doesn't quite fit in here. This would be the deal without recourse. At that point, if this was without any recourse, you would just record this and then a loss on sale for 6,000 plus 4,500, 10,500 altogether. But because we're adding the recourse and it's 3% of the receivables we sold, that's 9,000. So we want to credit a recourse liability. Oops. For 9,000. Now we credit it here, and this is our third component. So these three pieces, the 6,000, the 4,500, the 9,000, they combine now to give me my total loss on sale, which is 19,500. All right, so now that completes the journal entries. Oh, and just to make sure this is new, of course, cash increases assets, debit to cash, debit to a receivable, it's still an asset. The loss reduces net income. The accounts receivable crediting is reducing assets. The recourse liability credited is increasing liabilities. Okay, so take a moment and make a T account. We're not going to do the entire receivables account, but I already started it on the prior page when we were working through the receivables. There we go. We'll talk about why we don't really, in this case, need an ART account. So my allowance for credit losses, 52,000, 20,000 from the write-off. We had a reinstatement that credited my ACL. And then we had an additional write-off. So that's 19,000 here. Those were the only items that impacted ACL that we made a journal entry for. And so I'm going to line those up, get my unadjusted balance for ACL, which comes out to 18,100. So the reason why I'm calculating this is that I need it in order to employ this aging schedule. And why did I not need to do a ledger? Well, specifically the problem for ledger for accounts receivable. The problem didn't ask you to fill one out, and we can actually get the information we need from this aging schedule because the total of these amounts should always equal the ending AR balance. So if I sum those up, they should equal my total accounts receivable balance. Why? Well, the aging schedule, all it's doing is taking the amount of receivables you have at the end of a period and putting them into different categories based on how long it's been since the receivables were outstanding. Right? So it just said, well, this amount of the receivable balance is 1 to 7 days, then this amount 7 to 30 days, and so on for 30 days. When we total those up, it's $1,147,000. No units there. 1,147,000. So that would be the ending balance of my accounts receivable. I'm just taking that, again, multiplying across to get, well, how much of this 840,000 is going to be uncollectible? How much of the 210 is going to be uncollectible? So we do that, carry that across. The first row, 840 times 2%, 16,800. The next row in the same fashion is 12,600. And the final one is 11,640. If we total all that up, we get $41,040. And I just want to draw the parallel, right? Just as these amounts of receivables separated out into different categories of how long they've been outstanding totaled should equal my ending balance of receivables. Well, if I take these multiplied by percent, what I'm really creating is ACL in little categories. So if I total each of these up, this is my desired ending balance because it's not there. But this is what I want. The total allowance for credit losses should be at that piece. So that's my unadjusted balance. This is my desired adjusted balance, 41,040. But that just doesn't happen. We got to make it happen with an adjusting entry. And that adjusting entry is the amount I have to credit in this case to go from 18,100 to 41,040. That amount, when you take the difference, is 22,940. But we have to make a journal entry to put it there. So this is my adjusting entry. I'm sorry, this doesn't come chronologically with the rest of the problem, but this would be at January 31st. Bad debt expense for the amount that I had to credit, and then credit the ACL by that amount. All right. So that's the adjusting entry for bad debt expense. Of course, the bad debt expense itself reduces net income, and the credit to ACL reduces assets. So it asks for one more thing, and we already have all the pieces for it. And it does ask for the turnover ratio. I'm not going to hold you responsible for on this test for that. But I do want you to understand what the net realizable value of receivables are. So this is the amount that we find on the balance sheet. And remember, when we put these on the balance sheet for receivables, we take any case that there's a contra account, like ACL, we take the account that the contra account is attached to and subtract off the balance of it to get the number that's on the balance sheet. And so that's exactly what the NRV is for my receivables. The balance of the AR account minus the balance of the ACL account. So this would be the NRV 1,105,960. All right, so that really encompasses the receivables topics that we talked about all in one problem. This again is a little long for the test, but it's a nice piece to study to really think and reflect on why we record some of the things we do, making some good comparisons between gross and net method, and just fitting it all back into the accounting cycle with this adjusting entry performed to move an unadjusted to an adjusted balance.